Hey everybody, happy 5 Minute Friday. Dr. Holly here, and I am talking about taxes this week. So, as you guys know, this past week was our National Tax Day due for personal income taxes in the United States. For many of you, that was also an overlap of when your business taxes were due. Maybe your business taxes were due back in March if you are a corporation, or maybe you had to file for an extension, or your CPA did, because that is the timeline that they're on. But what I want to talk to you today about is specifically what we use that tax account for in Profit First. So as you know, in Profit First, we have 5 foundational accounts. This is how we run our business. We open up 5 bank accounts, and they all have very specific targets and intentions. Okay, so number 1, just review, is your deposits or your revenue, all the money that's incoming. Number 2 is your profit account. Number 3 is your owner's pay account, then your tax account, and then that last one are your operating expenses or your overhead expenses. Okay, so what do we use that tax account for? I want you from day in, from $1 to be depositing money into that tax account based on a percentage. I usually recommend starting at minimum 5%. Okay, I had an example of a client just last year who actually started out just 1%, but then was very, very aggressive with the rest of their Profit First implementation, really cutting expenses. Well, guess what? That made their business very profitable by the end of the year. So they actually did not have enough money saved up in that tax account. Okay. So I, very minimum, want you to start putting aside 5% of every dollar that comes in into that tax account. Okay. And what do we use that for? There's some misconception around this. It is for your income taxes. If you have a business, your business is generating revenue, that's giving you a tax liability. So you can use that as your own little savings account to put aside money, because even at the end of the day or year, depending on your business entity, if they're going to come back on personal taxes for you to pay taxes, you can take a draw from that tax savings account. It's just making sure that the money is there. Okay, right? It doesn't really make sense. Yes, you have to pay it personally to the IRS, right? It doesn't really make sense to have a business that's generating all this revenue and not actually do anything with that revenue, set it aside for the tax bill that's eventually going to come. Okay, so I'm all about living in the present, being realistic, etc. We have to know that the tax bill is coming. Okay, this is not for payroll taxes. Okay, this is not for if you have employees, you know that you have to have a withholding and you have an employer contribution that's made. And those are typically done on a monthly and a quarterly reporting. This is not what that tax account is for, because that's going to be transactional through every payroll period that you have. Okay, this is just for your annual taxes, which some of you will actually pay on a quarterly basis. Once your business is well established and you actually get to the point of having a tax bill, your CPA should set up what are called estimated payments for you that are quarterly, that you send to the IRS. It's like, hey, if your business was as, quote, successful as it was last year, we don't want you to say, wait to pay that $8,000 next April. We actually want you to send us $2,000 every quarter throughout the year, so that you are depositing into that bank account, and then it's a little bit more even keel once we get to April 15th of next year. Okay, that is what the estimated taxes are about. Some of your states will also have this set up. And again, your business has to be established enough to get to that point to have them. But what this tax account does for you is, that from day in, from $1, I say this all the time, you are putting money into that tax account, so that when your quarterly payment is due, you just draw it right out of that account. And hopefully, especially if you're working with a Profit First professional, you keep that line of communication going. And so, hey, here's my goal. By July, I have to have this much money to send to the IRS. Okay. And we work that number backwards. Okay. Even if you're not at, what the gold standard in the Profit First method is to make that 15%, that may not be what your liability is. Okay. Like I said, minimum of 5. Some people I have between 9 and 12. I've even had an office that was up at 17 because they have a high state income tax as well. So that is what that account is for. Now, at the end of the day, month, year, whatever, it is all still your money. If a true emergency comes up and you have to pull money from that, okay, fine. But you really don't want to be surprised by, whoops, here's the tax bill, or here's the estimated payment. No, that money's not, where it was supposed to be, right? So we really just want to be out of sight, out of mind with that, and leave it over there. What I also really like to do is for you to be able to pay your CPA out of that account, okay? I know my CPA has ranged anywhere from $500 to $900 a year for tax prep. Okay. I just want to be able to make sure that I am funding that appropriately so that, that's a large expense for me that wouldn't ordinarily happen. I wouldn't ordinarily have that happen, say, in a quarter, that I would have an unexpected expense like that. So I like to keep it stowed away in the tax account as well. There's my timer. I hope everybody is having a wonderful, beautiful spring. I know the weather here in coastal North Carolina has been absolutely beautiful. So see you next week, guys.